Did you know that the United States multifamily construction sector experienced a significant 30% decline in starts in May? This number fell to 316,000 units, marking the lowest start rate for buildings over 5 units since November 2024. Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. According to CoStar's analysis of Census Bureau data, several key factors contributed to this slowdown, including elevated interest rates, economic uncertainty, and the unknown impacts of tariffs on construction costs. However, while the headline-grabbing 30% decline might suggest a grim outlook, it doesn't fully capture the market's underlying health. Interestingly, multifamily development permits, a critical indicator of future construction, actually rose by 1.4% in May and are up 13% compared to last year. This divergence between short-term uncertainty and long-term planning signals an underlying confidence in the industry. Developers are leaning on strategic flexibility to adapt to shifting market dynamics. For instance, Avalon Bay Communities has maintained plans to increase development starts to $1.6 billion in 2025, although the timing remains fluid. This strategic agility is essential, given that recent tariffs could raise hard costs by about 5%, potentially rendering some projects infeasible. Yet, the broader market slowdown in new starts has improved subcontractor availability, which could help mitigate these cost pressures. Similarly, Equity Residential has reported that its operational performance is currently surpassing expectations. The company remains focused on core performance metrics, such as leasing activity, pricing trends, and overall demand, all of which are performing well and trending slightly ahead of projections. This focus on core metrics is a testament to the resilience of the multifamily sector. It's important to note that while the 30% stall in starts has undoubtedly grabbed the industry's attention, it's only part of the story. Permitting activity remains positive, and demand continues to run strong. According to CoStar, demand is projected to grow at an above-average pace, while completions are expected to drop by 45% this year, thinning the construction pipeline and driving vacancies downward through 2025. Of course, these projections remain subject to considerable uncertainty given the ongoing volatility in interest rates, trade policy, and broader economic conditions. Yet, with supply tightening and subcontractor availability improving, the slowdown in starts could very well set the stage for renewed development activity. There's always a silver lining to be found, and this situation could present a longer-term opportunity for those in the multifamily industry. In a significant move, Arlington, Virginia-based Blackfin Real Estate Investors has expanded its presence into Georgia by acquiring Sage Creek Apartments in Augusta for $17.3 million. This purchase marks Blackfin's entry into the Georgian market, and it comes at a price point that Doug Root, co-founder and managing partner of Blackfin, describes as advantageous. We've been looking at that market for a while, and this type of product was trading for $240,000 to $250,000 plus a unit, and we're in for around $140,000, Root told Multifamily Dive. Sage Creek Apartments, a fully gated 3-story garden-style property built in 2016, features 120 apartments with 9-foot ceilings, stainless steel appliances, granite countertops, and washer-dryer connections. The amenities provided include a coffee bar, swimming pool, 24-hour fitness center, bark park, and package service, making it an attractive option for renters in the area. Blackfin was particularly drawn to Augusta due to its regional economic drivers, such as the Augusta Medical District, Textron, John Deere, and Fort Eisenhower, which is home to the United States Army Cyber Command and the Georgia Cyber Command Center. The U.S. Army Cyber Command and the Georgia Cyber Command Center continue to bring technology professionals to the submarket, said Root. That cybersecurity space is not going away anytime soon. The property's strategic location, less than a mile from Interstate 20 and Interstate 520, ensures proximity to the area's many retail and employment offerings, further enhancing its appeal. Root expressed confidence in the market's fundamentals, citing a stable workforce and the lack of new supply due to high construction costs as factors that position the market to outperform. Since its founding in August 2016, Blackfin has acquired over 15,000 Class B and Class C value-add and Core Plus apartment communities across the East Coast. Its portfolio currently includes 10,000 units from Boston through Florida, representing a total asset value of over $2 billion. Root is optimistic about the future deal environment, noting that debt maturity and extended hold periods might motivate more sellers to bring properties to market. There's a little more of an expectation that this is how the market is now, Root stated. Shifting our focus to Washington, D.C., a notable development is taking shape in the Adams Morgan neighborhood. A restaurant building located at 2009 18th Street Northwest, which had shuttered in recent years, is now being eyed for a multifamily redevelopment. According to Ben Peters from the Washington Business Journal, a luxury home builder is planning to replace the existing structure with 31 multifamily units. This potential redevelopment is part of a broader trend of transforming existing commercial spaces into residential properties, particularly in urban areas where housing demand remains high. The adaptation of restaurant sites into multifamily units reflects developers' strategic responses to changing market dynamics and consumer preferences, especially in densely populated regions like Washington, D.C. The architectural firm Tees Warren Architects is reportedly involved in the design of this project, which aims to bring modern living spaces to the heart of Adams Morgan. This initiative could enhance the neighborhood's residential appeal, offering new housing options that cater to the diverse needs of urban dwellers. As we see more of these conversions taking place, it's clear that the landscape of urban living continues to evolve. Developers are increasingly recognizing the potential of underutilized urban spaces to meet the ever-growing demand for housing. This transformation is not just a response to immediate market needs, but also a forward-looking strategy that anticipates future urban living trends. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, MacKay. See you on the next one.